Alex Batlin, you're heading the UBS team at FinTech Incubator Level 39 in London, and you're working on a generic blockchain-based currency. Where are you in the development? When can we expect a cryptocurrency that can be used as easily as today's pocket money?
Thank you for that great introduction. But what we're looking at is at a cross range of applications for blockchain technology. So we're not per se looking to create a cryptocurrency. We're looking, for instance, how can you apply the technology, what people now term blockchain, to potentially fiat currencies, loyalty points, and so on. So we're not trying to create a new currency. We're trying to figure out if we can bring some of the advantages, such as distributed ledgers and perhaps smarter means by which we can transfer ownership of money under certain conditions. This is the idea of the smart contracts potentially acting as escrow agents, holding money in escrow, for instance, when you are buying or selling a house and you both put the deposit down and you want to make sure that if one or the other party pulls out, there's a penalty paid. So we're not looking at trying to replace existing payment rails like for like, because actually centralized systems are superior in that sense. They don't incur the penalty of duplicated execution. But once you start adding new capabilities, therefore you're not comparing like for like fiat central versus, for instance, either virtual or fiat on blockchain, but adding the extra layers of unique value propositions, that's when it becomes quite exciting and starts to make sense.
Cryptocurrencies don't need a single trusted advocate. The network is securing the integrity, while banks live on the need of their clients to trust them. Some see the role of blockchain as disruptive to the finance industry as the internet was to the media industry. How do you think cryptocurrencies will change the financial industry and the role of the traditional banks?
It's a great question. How will cryptocurrencies change the role? And I think this is, again, one of the things we need to probably separate out the idea of bringing fiat currencies onto blockchain versus true Bitcoin-like cryptocurrencies. And really the difference for me of the two is that in Bitcoin, the money creation algorithm is determined by, for instance, the blockchain or Bitcoin algorithm itself, through proof of work, mining, and allocation of rewards, such as currently 25 Bitcoins for the successful miner. And ultimately it's a deflationary currency, because once 21 million coins are issued, you no longer have any more money being added into the system. The alternative mechanism is to look at saying that, for instance, you don't need an intermediary to keep your money safe and to transfer it, so potentially taking some of the value proposition of what banks make money on, but at the same time still leave the central bank as the issuer of that new money supply. So that's an interesting kind of hybrid approach, where you're basically saying you still have a single authority responsible for the money creation and potentially destruction, but you no longer need centralized ledgers or banks to keep that money safe in principle. So I think it will have ultimately disruptive nature, because Bank of England, for instance, already noted almost a year ago the potential benefits of issuing fiat state currency on blockchain. But one of the issues they're trying to uncover is that will that actually disrupt retail banking? Because in principle, if you think about a current account as a bundle of interest-bearing instrument coupled with safekeeping, coupled with payments, in a current low interest rate environment, the two remain, and blockchain actually addresses both the safekeeping and the payment or transfer capabilities. If you no longer need to worry about kind of retail banking, because you no longer have that depository capability, what happens to wholesale lending, which is, of course, one of the main ways by which governments tend to enact their monetary policies. So technically speaking, in some ways it's trivial, although there are still some technical issues around transactions per second that need to be resolved. But it's a much bigger macroeconomic question about how money is created and distributed. So we need to take a very careful approach to this. There are many benefits, potentially, as we already talked about, such as escrowing money and so on. But at the same time, once you start changing the rules of money creation and money distributions, it has far wider reaching impact. And therefore, we want to make sure you don't destabilize the economy. And if you do want to change, do so in a steady, measured approach rather than a big bang approach. So I think there are many issues you need to consider. But what does it mean for banks? Well, let's imagine a hypothetical situation where people have their depository bearer accounts on blockchain, but they still potentially might want to have an instrument bearing account. Today we kind of mix it up together if you think about it. You kind of put money in a deposit account and you think it's money, but it gives you a bit of interest. You make almost a subconscious maybe decision that you'll get a little bit of interest in return for all those services. In the future, you might need to make a much more conscious decision. You say, if you want to have your money safe, no fractional reserve banking, no counterparty risk on the bank, then actually you just keep it on blockchain accounts. That's it. But if you want to have an interest-bearing account, then you start potentially using the blockchain in order to convert that money into interest-bearing account. It's one-to-one pegged, but now you introduce risk on the counterparty. In return, you get interest rates that compensate you for that risk. And I think that's a quite a nice fintech approach. It's very clear that you're not bundling together risk and reward. If you want to have no risk, you can get that, and if you want to have risk versus reward, you can also get that, but it's a very clear separation. And I think that's really beneficial to customers because they will have a much better capability to manage their risk appetite.
You touched on a very delicate issue, is the creation of money. Who do you think in the future will be responsible for the creation of money and for the amount of money that is being created?
It's a hot topic right now, who does create money. I think obviously Bitcoin is somewhat based on blockchain, on gold, and gold is almost finite supply. Of course, we can mine more gold, and perhaps in the future we can combine it through atoms to create new gold out of thin air. Who knows? At which point it will no longer be a good, valuable resource. But typically speaking, a fixed supply, monetary fixed supply, tends to lead to deflationary currencies. And there's a lot of economists that say that deflationary currencies are bad because ultimately they do not scale out as productivity increases and causes lack of investment in the economy because people hold on to money thinking it'll be worth more in the future and therefore don't invest. And that's why a lot of governments have an inflationary policy. Bank of England has a 2% inflationary policy to kind of stimulate the economy to invest in, because just holding the money, well, at the end of the year, you'll have £98 versus £100. And I think there are advantages to those systems. Problem is, of course, then there's a risk that if money supply is excessive, it creates excessive inflation. And then it's really difficult to kind of understand who benefits from the increased money supply. How is that new money is distributed into the economy? So it's a very delicate question. I haven't seen anybody address it well. Bitcoin went for the solution around gold, but of course we've seen that a lot of economies couldn't survive on gold standard and moved away from it. So do we think that an electronic version of gold is going to work too? I'm not sure. At the same time, perhaps there is a better algorithm to create new money supply versus what we have today, and that's one of the, I think, experiments that some of the folks in the virtual currency world are working on. And I know even central banks are openly discussing kind of alternative to current fiat models. I think Switzerland was one of the first countries to have a vote on the fact whether or not you want fractional reserve banking, which is one of the linchpins for current fiat money creation.
The blockchain community was not all over enthusiastic about the strong role UBS tries to play in the development of a new cryptocurrency. What are the goals of UBS? Which role does it want to play in the future of currencies?
So first of all, to be honest, I haven't personally received any negative feedback. I think there's a general feeling that perhaps if banks take over too much in this space, then it undermines maybe some of the ethos behind Bitcoin. But I actually see the two worlds very separate. I think there is a space for censorship-free, unregulated, effectively, asset classes like Bitcoin, coexisting very happily with more regulated, perhaps fiat-based asset classes in tandem. And for different purposes, there are different tools, and you choose the tool you require. Bitcoin potentially excels very much in the international space, where if you don't want to have exposure to the economic biases of the issuing country, but you need to do international trade, perhaps Bitcoin is actually a pretty good instrument. Too many people talk about the illegal use of Bitcoin, but actually there's a very valid use of Bitcoin where if you want to do trade, you might not want to be exposed to some issuing countries' policies, and therefore you choose to have a neutral currency like Bitcoin. So there are use cases there. At the same time, it might be that for domestic payments, there is, in a stable economy like Switzerland, there's less benefit in using a virtual currency, and it's just easier and in some cases legally required to use fiat currencies. So I think there are, we're not trying to get into the virtual currencies at all. The point is to try to figure out how to make existing regulated banking better through application of this technology.
Well, UBS is very much at the forefront compared also to other banks. So what is the real goal there for UBS?
I think the real goal is always very simple. For me, innovation is all about agility. We need to be able to understand how life is changing, both in terms of technology, regulation, finance, but also the macro changes, the social, political changes, the generation gap. You know, if 10 years ago folks would have accepted a delay because we were used to post, for instance, nowadays you kind of think I can talk to somebody on the other side of the world through Skype instantaneously, yet money takes 4 days. People no longer starting to accept that. So we need to shift with that. So innovation is key because we need to listen for change and we need to have the skills to react to change. And blockchain is potentially a very big change. Other technologies also exist like IoT, like artificial intelligence. But unless we have practiced learning and working with those, we will not understand whether A, they're suitable for application, and B, if they are, how would we do that? So it's important to have those skills to react quickly when we need to, but intelligently. And it's really for two purposes. For our clients, we always strive to provide the best services to our clients, and if there is a new way to do something that offers a superior product, then we want our customers to benefit from that. At the same time, of course, protecting shareholder value. We've seen what happens to companies that do not react to change positively. They cease to exist. So it's important to protect our shareholder value as well by making sure that we stay relevant and keep on top of the progress and adjust to it.
Blockchain can serve not only as the foundation for cryptocurrencies, but also as a ledger for any possession. Which applications are you and your team exploring beyond the pure cryptocurrency approach?
Really looking at blockchain as a cross multi-asset capability, because it's really important, in my opinion, not to just have a chain for money, but it becomes really useful when you can have a chain for other assets. So we did an early experiment we called smart bonds. So this is looking at how could you issue, without any intermediaries, a bond by company A to be bought perhaps by hedge fund B. We also tried to push the boundary a little bit, and instead of just tokenizing the bond itself and perhaps providing one method, transfer it to somebody else to buy it or to sell it, we also said, well, can we push the entire life cycle of a bond to be a smart contract? And actually we did do. So in the way we've coded the smart bond, you can do it in different ways. The bond itself acts as an escrow agent. So when an issuer issues a new bond, the new bond has its own account. And this is the big difference between code and a smart contract, because a smart contract is also just code, but because it is executed by this crowd of people and requires consensus, it is autonomous. So nobody can change unilaterally what it does and how it does it. And this code also has its own wallet address. It means it's almost like a human being organization. It can own assets itself. So what does it allow you to do? Well, it allows people, for instance, to invest in that bond by sending during the issuance period of the bond money in escrow to the bond. So the issuer doesn't have the money. The money goes and is owned by the bond itself, and only when the bond is issued does the money come out of escrow to the issuer. So the advantage of that system is if the bond is never issued, the money is guaranteed to go back to the investor. Or if there's overlocation and the issuance is below the amount of money that's been put into escrow, people are guaranteed to get their money back. So all of a sudden you don't need an escrow agent managing that process, a broker. At the same time, once the issuer receives the money, we create almost like an automatic direct debit capability. So that bond is now authorized to withdraw money based on a coupon payment schedule automatically. It knows who the owners are, so it redistributes the coupon payments automatically. So the entire servicing of the asset, from coupon payments to maturity, through to initial public offering, through to secondary markets, is fully automated and completely disintermediating. Obviously, this is a technology trial, and therefore there's a long way to go in terms of both the scalability of blockchain. At the same time, the current regulation is designed in such a way that it uses today's technology, and today's technology is predicated on central services, not distributed autonomous organizations. So it'll take a little bit of time before the benefits of this technology can truly reduce a lot of the intermediary costs, but the path is pretty clear, frankly.
How long do you think it'll be before all the legal and compliance aspects will be covered to allow this concept to become a mass market phenomenon?
That's a really tough question. I think in some areas you get to see it much more immediately. So for instance in UK, the regulator's been really good, and they've created a kind of almost a special section for peer-to-peer lending within their kind of framework, as well as for mini bonds. So those constructs are already lightly regulated, and in fact almost immediately can benefit from blockchain. Because if you are trying to create a peer-to-peer lending site where the platform holds the money in escrow for a short period of time before during the syndication process and before the money is released to the intended recipient, you have to trust the platform, frankly, not to misappropriate those funds. On the other hand, if this is based on blockchain, then actually that money can be escrowed by an uncorruptible smart contract. So for some of the more alternative finance, the applications are clear right now and do not actually require regulatory change in most cases. But for more kind of regulated use cases where around publicly traded bonds, then I suspect it'll be a number of years before we shake out the technology and people truly understand the risks associated with it. Because frankly, what is a distributed autonomous organization? It's a new construct that doesn't have legal representation. So there's a lot of questions that need to be kind of ironed out before I would put kind of a lot of money behind it.
While we are still able to read books that were written some 3,000 years ago, we often cannot access digital information from 10 years ago due to the lack of appropriate hard or software. What does that mean for the long-term validity of systems in which the only proof of possession is a piece of digital code?
That's a great question. Obviously, technically, just because you can read a piece of paper, I find often reading script quite difficult. So it's an interesting thought exercise, but we do know that paper and most other records also deteriorate, and it's a common problem. So open standards and ability to export data, import data, share the data are key. One of the big advantages, as far as I'm concerned, about blockchain is the fact that it's highly distributed, so there's no central point of failure. If today's bank fails, for instance, how would you prove how much money you have? It's pretty damn difficult. On the other hand, if everyone acts as their own mini bank and there is a consensus view about how much money somebody has, it's a far more resilient system. So the risk comes if something like a network becomes redundant because people migrate off it, then the data is not transformed into newer versions of that data and archived. And then to bring back the archive, you probably no longer have the original operating systems and the software to do that. So that's an issue. But frankly, you might argue that if nobody's using the system, then it's irrelevant. And if people are using it, a network effect like Bitcoin will guarantee the propagation of data. So perhaps it's a non-issue.
Alex Batlin, many thanks for your time.
Thank you. Cheers.